Welcome and thanks for joining the second quarter review from Horizon Investments. My name is John Drahzal and I'm joined by our CEO, Robbie Cannon. And what we'd like to do at the outset is to talk a little bit about the industry. Now, Robbie, I've been doing this for 30 years and I've never heard so much about change and the pace of change and the acceleration in change. How would you comment on that?
You know, it really has taken 30 years to get to this point. And what's amazing is we talked about this a year ago on LinkedIn about this idea of Copernican revolution. And Copernicus was a mathematician that talked about the sun at the center of the universe, not the earth. For some reason, the financial service industry has been centered around the institution for 30 years. And now this idea of a pace of change or feverish change is really a reorientation around who the customer actually is in financial services. And we believe, and the advisor believes, it's the individual, not the institution.
So when we think about this reorientation around the individual, with us being a goals-based manager, how does that play into that?
The advisor has always been a goals-based wealth manager. This is just language that we're using now in 2019. But what I would say is that it's going to be really important for advisors in the future because there is a change in terms of the reorientation, whether it's technology, services, and product, that are going to drive advisors in terms of their being able to deliver on this goals-based wealth management.
We often talk that the advisor has not really experiencing the change because they've always been there.
They've always been there, but look, for 30 years now, because the institution's been at the center, they've been dealing with a headwind in terms of the industry, in terms of way things are categorized or questionnaires are worded. And now the change or the reorientation that's occurring is actually promoting new technology, new services, new products. They're actually going to be a boon for the advisor. It's going to be a lot of fun because now the whole financial service industry is at its back. And so they're going to experience a tailwind. It's going to be a lot of fun, and I can't wait to see what happens.
That's terrific. Thanks very much.
Thank you.
I'm now joined by our Chief Investment Officer, Scott Ladner. Welcome, Scott.
Thanks, John.
Let's talk about interest rates. It seemed in the second quarter, rates dropped precipitously across the curve in the U.S., and we have approximately $13 trillion worldwide of negative yielding debt. Where do we go from here?
You know, we're going probably not a whole lot of anywhere from here, for a little while at least. Rates have dropped a lot globally. And it's important though to know that they have dropped globally, and not just in the US. Part of that is due to some growth prospects that have gotten a little bit more challenged since Trump escalated the trade war with China. We think that's going to end up getting resolved. But we do have some other factors at play. Namely, the global central banks have turned more dovish. So that's going to end up being good for asset prices, but also downward pressure on rates. But we've also had some speculative interest and some mortgage interest that are more technical reasons for rates going down, but they're important nonetheless.
Well, you mentioned Trump and the trade war. It almost seems as if the second quarter was defined by a single tweet on May the 5th.
You know, watching Trump's Twitter account ends up being very important for risk management and for managing money in this era. We do ultimately think that despite the fact that Trump escalated those tensions on May 5th with that tweet, that we're going to end up getting a trade deal done. It is in both parties' best interest, still to get a trade deal done. Trump, because a trade deal means the U.S. economy is probably going to grow at a faster pace, and so his presidential prospects improve. And China, because they want to cut back on some of the stimulus measures that they've had to employ over the last 12 months that have really helped goose their economy or gird them against an impending trade war. The key thing that we're watching, though, is, again, Trump's Twitter account. You know, Trump, our president, is not somebody that shies away necessarily from calling his foes a nickname on Twitter. He's pointedly not done that with the president of China. We think if that continues, and Trump continues to be respectful to him, to the president of China on Twitter, that signals that the personal relationship that Trump has with him is more important, and that is a key thing that we're watching.
Okay. Well, let's look at the second half of 2019, but let's first look at the second half of 2017 and 18. 2017, we had a double-digit returns. 2018, we had double-digit declines. That created very different sequence of return issues from a client perspective. What do we think for the second half of 2019?
You know, we do think the sequence is going to be a little bit more challenged than it was in 2017. In other words, a little bit more choppy than it was in 2017. But certainly the result is going to be not like it was in 2018. So we do think that the markets are going to end up higher through the end of the year, but probably in a little bit more volatile fashion than we saw a couple of years ago. The main reasons for that are the fact that we have global central banks reconverging towards a dovish stance. We do have choppy progress, but forward progress nonetheless on trade talks. And we also have investor positioning in such a place that both retail investors and professional money managers are positioned rather bearishly right now. When both those camps are positioned bearishly, it tends to be contrarian, and we do get markets going higher from there.
Thanks very much, Scott.
Thanks, John.
On behalf of all of us at Horizon, thank you for joining. We're grateful for your partnership, and we're eager to speak with you. Please reach out to our team via email or by calling us. Thanks very much.